people. Hope you're all doing good. So in this particular session, we'll be quickly running through RTP May 25 of our FR paper. So overall, if you ask me, how is this RTP structured or any new questions are there? A couple of questions has been newly framed. They are pretty good. I think we should review them. Another 2-3 questions, you could say a little different, but the concept are the same, which you can manage. But other than these 4 or 5 questions, whatever other questions we see in this RTP is pretty much cut, copy, paste from our class materials or ICA material or previous RTPs for that matter. Okay, so that is the overall average. Yeah, because of the couple of questions newly added, I would say this is probably a little better RTP from ICA in this particular attempt. All right. So let's see what we can learn. And moreover, in this particular, through this RTP, we'll be covering all those new questions. All right. If it is repetitive, then I'll not bother. I'll not waste your time, not mine. So only the new questions is what we'll be covering in this particular RTP. Yes. So without delay, let's get started. Okay. Case-based questions first. This is a question on IND AS 103. Pretty straightforward. In fact, this particular same question is already there in our class material. But since it's first question, so let's do it off. Okay. So ABC is a dynamic company, blah, 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 and all they are telling. Okay. Okay. That story they have given. Let's not worry about the story. Let's get into the main matter. So what is the main matter? Following acquisition has taken place. So ABC is probably acquired some companies. So relating to that certain information they've given. ABC has acquired beverage company PQR Limited. So ABC is the acquirer and PQR is the acquiree. And the acquired PQR share from an investor called XYZ. That's okay. Whoever want, we can purchase. But basically PQR shares is what we have acquired and ABC controls PQR. Okay. At the time of acquisition, PQR Limited is already a defendant in a court case wherein certain customers of PQR have alleged that the products of PQR have certain pesticides. So some products of PQR Limited has caused some problems and some customers have filed a case against acquiring. Now we know this. There's a concept of what's an indemnification asset and contingent liability. Yes, that's a concept they're trying to test. PQR is being sued for damages of 2 crore rupees. All right. X Limited has indemnified ABC. Okay. Because we purchased the shares from XYZ Limited, right? So obviously if the PQR is found guilty, it will be unfair for ABC Limited, right? Because they have paid the money and they've acquired the share. So if the other company, acquiree, found guilty means the value of the investments of ABC will fall down. Hence, ABC has asked for indemnification or compensation if something bad happens. From whom? From the person we have acquired the shares, which is XYZ. So XYZ has indemnified ABC Limited, if any, for up to 1 crore rupees. This only we call it as indemnification asset. Yes. The fair value of contingent liability is 0.7 crore. And we have studied IND AS 103 has a recognition exemption. Normally, as per IND AS 37, contingent liabilities are not recorded. They are only disclosed. But however, if contingent liability arises due to business combination, that is IND AS 103, IND AS 103 gives an overriding rule, sir, that this contingent liability also should be recorded. Subsidiary contingent liability also should be recorded. At what date? At what value? The fair value on the date of control, which is what? 0.7 crore. All right. So that means we have to record on liability, but at the same time, we have an asset also. We can claim compensation. If the subsidiary company is found guilty, we can claim this amount back from the XYZ. So this we call it as indemnification asset. Both we have to show. But there is a rule. What is that? Sir, indemnification asset cannot exceed contingent liability amount. It's common sense, no, sir. If we suffer a loss of 0.7 crore means will the other party compensate 1 crore? No, it is up to 1 crore. It's not 1 crore, up to 1 crore. If you suffer a loss of 0.7, then the other party will only compensate 0.7 crore. All right. So that means in this, looking at this case, we will record both indemnification asset and contingent liability to the extent of what? 0.7 crore. That's the first answer to the first case study. What would be the amount ABC will recognize for indemnified liability and contingent, both indemnification asset and contingent liability will record it at what value? Both value recorded at 0.7 crore. That's the first. D for Delhi is the right answer for the first option. What will be the impact on goodwill due to the recognition of both? Will there be any impact? No. Sir, you're recognizing one asset, you're recognizing one liability, both at same value. What is the impact? There is no impact on net assets, right? Because you're recognizing both an asset and liability means net asset may there is no impact. So goodwill also there will be no impact because the same value. All right. Now third case, in case the fair value of identified liability is 1.2 2 crore. Now they're modifying. In case contingent liability is 1.2 crore means in that case what will happen? Instead of 0.7, if it becomes 1.2 what? In that case, you will record your contingent liability at 1.2 crore and indemnification asset you can't record it at 1.2 crore. Maximum indemnification or compensation possible is only 1 crore. So IA will be recorded. Indemnified asset will be recorded at 1 crore in this particular case. So option B for Bengaluru is the right option. Or what is the value of liability and indemnification asset? You will recognize this thing. That is 1.2 and 1 crore rupees. Fine. All right. Now, what will the impact on goodwill? Now, if this is the case, means what will be the impact on goodwill is what they're asking. Sir, this will have an impact on goodwill. How? Sir, are you recognizing both liability and assets at same value? No. Liability you are recognizing it at 1.2. Asset you are recognizing it at 1 crore. That means what is higher? Liability is higher by 0.2 crore. Yes. You're recognizing a liability for 20 lakh rupees or 0.2 crore more. Sir, if liability increases, what will happen to your net assets? If liability increases means net assets will reduce. And I had already told you in your class that net assets and goodwill have inverse, ulta relationship. If net asset reduces means goodwill increases. If net asset increases means goodwill reduces. If net asset reduces means goodwill, whatever. The ulta relationship basically, yes. If you want, I just brought in some numbers also to prove it to you. We have done all this in our regular class. Suppose PC is we have purchased 100% control and PC paid us 90 lakh. I've just assumed a hypothetical case, okay? Random numbers. This is not related to this case, okay? NCI is obviously 0 because it's 100% control. Let's say fair value of net assets is 80 lakh. In this case, what will be the goodwill? How do you get goodwill? PC plus NCI minus fair value of net assets on the date of control. If you do that, you're getting 10 lakh. Suppose if this fair value of net asset reduces, why it will reduce? Sir, if liability increases means net assets will reduce. From 80, if I make it to 70, what will happen to goodwill? PC is same. Only this number from 80, if I change it to 70 means automatically from 10 lakh, the goodwill will become 20 lakh. Why? Because your net asset reduced by 10 lakh, goodwill also increased by 10 lakh. Same thing happens over here only. Since your liability is more by how much? 0.2 crore. Okay, the fair value of net assets will reduce by 0.2 crore. Since net asset is reducing by 2 crore, goodwill will increase by 0.2 crore. So the net impact on this transaction is there will be an increase in the value of goodwill to the extent of 0.2 crore. Okay, so that was the first scenario which they had asked about for MCQ question. And there is one more in the same case scenario one. There is one more part. Let's analyze this further. This is also same ditto question in our class material. In fact, all these are there in ICA material only. ICA material question these are. A descriptive question they have converted into MCQ question and formed it. All right. Now ABC pays 50 crore to acquire RST, another company. Right. Same acquirer now has acquired another company, RST from MN Limited. That's okay. RST is manufacturing fiberglass and has been named in 10 cases. Similarly, now this particular acquiry some cases has been filed already. All right. For which MN agrees to indemnify ABC to the up to 10 crore rupees. So indemnification asset here is there to the extent of 10 crore. The clash actions have not specified the amount of damages and past experience suggests that the claim may be 1 crore each, but they are often settled for smaller amounts. So obviously many cases are going on, no? So they are saying sometimes the value of each case ka liability may be 1 crore, but it could be lesser also. Now ABC Limited makes an assessment of court cases and decides that due to the potential variance in outcomes, contingent liability cannot be measured reliably. Sir, if IND AS 103 says contingent liability should be recorded at what value? Fair value on the date of control. So you should be able to find out fair value. Here they're saying you're not able to find out the fair value. And accordingly, no amount is recognized. They're saying, yes, if you're not able to find out fair value, contingent liability is recorded at 0. That's our answer. But here we have indemnification also. Indemnification asset also 10 crore. Can we recognize that? No. Sir, indemnification asset cannot exceed contingent liability value. If contingent liability ka value is 0 means IA, indemnified asset ka value is also 0. Here both the things will be recorded at 0 itself. Here they ask at what value indemnification asset will be recorded. Obviously both IA and contingent liability will be recorded at 0 only in this particular case. Yes, this is a pretty straightforward MCQ question. Nothing new to learn as such. This is a repetitive. Yes. Okay, next one. All right, next is a pretty good scenario. I mean, similar question is there in our class notes, but I would still say we have solved in a descriptive way. Now they're asking pretty much the same question in an MCQ format. So let's see. So they've given you a case. You need to answer question number 6 to 10 with the help of this particular case. 1st January 20x6, 7,500, you have acquired the asset. That asset ka life is 10 years. Okay, you bought the asset. Great. At what value? 7,500. Now, drama started on 31st December 20x7. All right. Sir, when they give you the data and like when they start with January and if they give you all other data in December, always assume that the company is following the calendar year. Here, in fact, they've told also, calculate the amount of depreciation for the year 20X8. Sir, if it is April to March, they will not say X8. They'll always say X8, X9. Okay. The moment they say X8, it means that the year is starting on 1st January 2008 and ending on 31st December. So calendar year is what being followed for as financial year in this particular case study. Okay. Now you purchase the asset on 1st January, maybe I'll call it as 16 for simplicity purpose. You purchase the asset on 1st January 2016. Now on 31st December 2017, them something the same. From here to here, if you count, how many years? 2 years have passed. So let's reduce depreciation for 2 years and calculate the carrying amount. Originally, you bought the asset for 7,500. Reduce depreciation for 2 years. 7,500 carrying amount minus residual value not given 0 divided by useful life 10. If you do this, you will get 1 year ka depre. We want it for 2 years. So multiply by 2, you will get 1,500 as depreciation for both the years put together. After reducing depreciation, the carrying amount on 31st December 2017 is 6,000 rupees. Fine. Now on this particular date, some drama has happened. What drama? Check. On 31st December 2007, there was an indicator of impairment. Impairment indicator has come. Whenever impairment indicator comes, we find out recoverable amount. Compare carrying amount with recoverable amount. If carrying amount is greater than recoverable amount, we'll have to book an impairment loss. So indicator of impairment has come and impairment allowance accounted. So impairment allowance means impairment loss. So 240 is the impairment loss they only given. We don't have to find recoverable amount. They only gave impairment loss. How much? 240. So now you have to book it. When you book an impairment loss, what will happen to the carrying amount? It will reduce. It was 6,000. Now due to impairment loss, it will reduce by 240. 240 is the data given in the question. So the revised carrying amount on the same day will become 5760. Basically, this is your recoverable amount. We know after we book the impairment loss, carrying amount and recoverable amount will become same. Okay, sir. All right. This is the drama on 31st December 20X7. Next, what they gave. On 28th February 20X9. So from here to here, we need to go now. That's some more years have passed. Okay, let's do a thing. Let's go one by one. From 31st December 2017 to 31st December 2018, 1 year has passed. First, let's calculate depreciation. Sir, we can't take earlier depreciation. Huh? No. So due to impairment loss, carrying amount is getting revised. If carrying amount, useful life or residual value changes means the original depreciation will not hold good. It will get revised. So let's calculate the revised depreciation now. How do you get revised depreciation? Revised carrying amount minus residual value divided by remaining useful life. After impairment loss, revised carrying amount is 5760. Residual value is still not given 0 divided by remaining life. When you bought the asset, life was 10 years. 2 years have already passed. That means the remaining life is 8 years. So into 1 because we need 1 year ka depre. So this is the depreciation. Reduce it. So your carrying amount as on 31st December 2018 has become 5040. We want this date ka carrying amount? No. They told drama happened on 28th February 2019. Sir, currently we are on 31st December 2019. We want 28th February 2019. So from here to here, if you count, that's another 2 months. So reduce another 2 months ka depreciation. That's all. All right. So carrying amount is 5040. Again, calculate the depreciation. For next year, what will be? Carrying amount 5040 minus residual value 0 divided by remaining. Previously, when you calculated, remaining life was 8. 1 year has passed. So remaining life will become 7. If you do this, you'll get same depre. Okay, if you do this, in fact, if you just check also, 5040 divided by 7, if you do, you'll get same 720. But now we don't want the depreciation for whole year. Drama happened on 28th February. So from 31st December to 28th February, if you count, that's 2 months. Hence, we have done 2 by 12. We want only depreciation for 2 months of this year. Okay, because we are solving the specific question. That's the reason. So 2 months ka depre, if you reduce, the revised carrying amount on this date will become 4920. This is the calculation. Now, what happened on 28th February 20X9? Let's review. On 28th February 20X9, the asset has been classified as held for sale. Sir, the moment an asset gets classified as held for sale, we need to apply IND AS 105. Correct? Now, IND AS 105 will attract. And IND AS 105 says what? Initially, the day asset becomes held for sale, initially as well as at every reporting period, non-current assets held for sale should be valued at carrying amount or fair value less cost to sell, whichever is lower. So we know the carrying amount. On the day it is classified as held for sale, carrying amount is 4920. We have got it. Do you know fair value less cost to sell? Yes. On 28th February, the fair value less cost to sell is given to be 4,600. Take that. So fair value less cost to sell is 4,600, which is lower. Carrying amount is 4,920. Fair value less cost to sell on the date lot classified as held for sale is 4,600. 4,600 is lower. That means you'll have to book an impairment loss. Yes, that reduction only we call it as impairment loss, but this is impairment loss not as per IND AS 36. This is impairment loss as per IND AS 105. These took a difference is 320. So entity will book 320 as impairment loss as per IND AS 105. And then what? The revised carrying amount from 4,920, if you reduce 320, the revised carrying amount will become 4,600. On 28th February, after your IND AS 105 application, the revised carrying amount will be 4,600. Yes. Okay. Next, what they told on 30th June 20x9, fair value less cost to sell. Have they told intention has changed? No. On 30th June also, asset is still non-current assets held for sale only. Just that they've given fair value less cost to sell. What does IND AS 105 say? Initially, as well as at every reporting period, you have to value the asset at carrying amount or fair value less cost to sell, whichever is lower, right? Now on 30th June, they've given. Now currently we are on which date? 28th February. Now we need the value on 30th June, meaning about 4 months later. That means calculate 4 months depreciation, sir? No, we know this. We have studied. Once an asset gets classified as held for sale, will we charge depreciation on that asset? No. Depreciation will not be accounted for non-current assets classified as held for sale. So the carrying amount on 30th June also will be same because depre is not accounted. Okay, sir. Now 30th June ka carrying amount we got. What is the fair value less cost to sell on 30th June? 5,300. Watch out for this. 5,300. So carrying amount or fair value less cost to sell, whichever is lower. This is one. But hang on. What is it? Sir, initially when, here check this. Carrying amount was 4,920. Fair value less cost to sell was 4,600. You booked impairment loss, right? When carrying amount was greater than fair value less cost to sell, you booked impairment loss as per IND AS 105. Correct? This is what we did initially. What if this equation becomes ulta? If carrying amount is lesser than fair value less cost to sell, or rather if fair value less cost to sell is greater than carrying amount, means whatever impairment loss you booked till now, that you can reverse. IND AS 105 permits impairment loss ka reversal, right? So here when carrying amount was greater than fair value less cost to sell, you booked impairment loss. Now when the equation has become ulta, when carrying amount is lesser than fair value less cost to sell, whatever impairment loss you booked earlier can be reversed, right? And once an asset is classified as held for sale, you can't apply IND AS 36 and all. Everything will come under IND AS 105. So whatever total impairment loss you booked till now, that you can reverse. Total impairment loss means the impairment loss booked as per IND AS 36 as well as IND AS 105. Both impairment loss, it is permissible to be reversed. How much impairment loss totally have you booked? As per IND AS 36, you booked 240. As per IND AS 105, you booked 320. So if you add these two, well, how much is that? 240 and 320. Both if you add, you'll get around 560. So the total impairment loss charge till now is 560. Right? So don't find from 4,600, don't increase the carrying amount directly to 5,300. No. Whatever. What is this? 4,600 minus 5,300. If you do, the difference between these two is 700. Can you reverse 700? No. You have charged impairment loss of only 560. So the lower of the two. All right. Maximum the carrying amount can become 5,300. That's what it is. All right. Maximum after reversal, the carrying amount can become 5,300. But you have booked not impairment loss. That these took a difference maybe 700. But have you booked 700 as impairment loss till now? No, you booked only 560. So only 560 ka impairment loss you can reverse. So when you charge impairment loss, carrying amount will reduce. When you reverse it, carrying amount will increase. So from 4,600, carrying amount will increase by 560. If you do it, the revised carrying amount after all this drama is 5160. This is the data, right? Now using this concept, they have framed some MCQ questions. Some of the values they'll ask, which we need to tick. What is that? Amount of depreciation for 2018. We already know 2018 ka depreciation is this 720. Which option is that? B for Bangalore. They are asked for depreciation for 2019. For 20x9, 2 months ka depre. How much is that? 120. So 120 is the answer. D for Delhi. What is the carrying amount of the asset before it got classified as held for sale? Before an asset got classified as held for sale, its carrying amount was 4,920. Check which option is 4,920. A for alpha, right option. Yes. What is the carrying amount of the asset after it got classified as held for sale? After it got classified as held for sale, we'll have to value at carrying amount or fair value less cost to sell, whichever is lower. So we valued at what? After IND AS 105 got triggered, the revised carrying amount became 4,600. Which option has 4,600? C for Chennai. That's the answer. What will be the amount of reversal of impairment loss and carrying amount they're asking? How much reversal will you do? The final answer. Reversal allowed is 560. After reversal, the revised carrying amount is 5160. Which option has 560 and 5160? 560 and 5160 is option number C. Chennai is the right answer for this particular MCQ question. Yes, people, pretty straightforward. Nothing new. We have a similar question already. We have done it in our class. But as a descriptive, here it came as an MCQ, right? Alright, but maybe because of that, still you may keep this question as an LDR question in that regard. Okay, next, IND AS 28 investment. Now, MCQ question part is done. Now, the descriptive question they've asked. Alright, 2-3 questions are there newly. Rest everything pretty much taka, it'll go on. Okay, nothing much. Okay, this is a good framing, I would say. I would probably keep this also as an LDR question. Okay, not we have applied this concept not with respect to associate. We have applied this concept with respect to subsidiary company. All right, step acquisition we have learned, right? What is step acquisition? You'll not get the control in one shot. You'll get it in installments or in stages. So in that case, what we used to do, whatever investment we already had, did we take it at cost? No, we always took the fair value of existing investment, right? So we took PC, right? In fact, we are told there are many 6 components of PC, right? New shares, so fair value of existing investment, SBPR, contingent consideration, deferred consideration, like this and all. So existing investment, always we used to take it at fair value. That concept we have applied in subsidiary consolidation. Here the same concept has been applied on associate. What in associate company will have significant influence? What if you get significant influence not in one shot but in stages? That's all is this question all about. Okay, so let's see. A Limited acquired 10% interest in X, rather acquired 10% interest in V. With the 10%, it's a normal investment, right? You won't get significant influence. Only if you get significant influence, you have to apply IND AS 28 ka provision for consolidated financial statement in associate, right? If it's a normal investment, then that normal investment has to be valued as per, if you purchase normal equity shares of another company, that's a financial asset. It will be valued as per IND AS 109. For equity investment, the default category is FVTPL, but company also has an irrevocable option of FVT OCA. Here, let's see what the company has opted. We have acquired 10% interest in V for 50,000 on 1st June. Okay. The investment was accounted as equity investment, not held for trading, in which irrevocable option has been availed. So they've gone for FVT OCA method. All right. So that means at every reporting period, initially as well as at every reporting period, investment has to be valued at fair value. And any fair value gain loss, we will transfer it off to OCA, right? You bought the investment. Here they've asked the journal entry. So when you buy the investment, the journal entry will be financial asset account, investment account debit to bank account. How much did you buy it for? 50,000. That is the entry you will pass. And you have chosen to value this investment at FVT OCA. Correct? Okay. X Limited has recognized increase in fair value, 30,000. Fair value is increased. Obviously, where will this fair value increase go to? Since it is FVT OCA method, this gain will be transferred off to OCA. So the entry will be, since it's a gain, the entry will pass as financial asset investment account debit to fair value reserve, or you can directly write OCA. That's fine. So how much is that gain? 30,000. So that means on 31st March, I think they gave all this data on 31st March. Yes, on 31st March 20x7, the value of investment in our books is, though we bought it for 50, there is a fair value gain of 30,000. So the carrying amount is 80,000 at the end of the year. Okay, this was current year, nothing else. Fine. Okay, next year what happened? Check. X acquired an additional 25% for 2 lakh on 1st April. The very next year ka first day, we purchased an additional 25%. So we already had how much? 10%. We already had a 10%. At the 10%, we didn't have significant influence. Okay, when we had 10%, we didn't have significant influence. Now we purchased another 25%. That means totally we have now 35%. With 35%, will you get significant influence? Yes. Now we got significant influence. What to do? So the moment you get significant influence, can you use FVT OCI method? No, sir. Now it is your investment in associate. Investment in associate, you'll have to value as you have to apply. You'll have to apply IND AS 28 ka provision equity method. So you have to come out of your financial instrument ka FVT OCI accounting and move into IND AS 28 ka accounting, because you got significant influence. The moment you have significant influence, you have to prepare equity method. Consolidation is prepared as per equity method. Yes. Okay, all right, and acquired significant influence. The fair value of net assets was 2,50,000 on June 20x6 is the first day you purchase the investment. We don't need that because we didn't get control at that point of time. The fair value has become now 4 lakh rupees on 1st April 20x7. We will see what to do for this. Okay, all right. How should X Limited account for the investment in V Limited on account of piecemeal acquisition when investment provides significant influence? Pass the necessary journal entry is what they're asking. Okay, Saru. All right. Now, what is the drama? Simple. Now, sir, since initially we are showing in our books now investment, right? But this investment is valued as per Ind AS 109. Can we do this anymore? No. Now investment has to be valued at equity method, right? So how much investment we purchased? Previous investment we purchased for 50. Can we record it at that? No. The moment you like same like your subsidiary consolidation. If you have already any investment, you have to take existing investment at fair value. How much is the fair value? Here, 50,000 you purchased for. There was a fair value gain of 30,000 means the fair value of the investment is 80,000. You can also confirm that also. How? Sir, you paid how much? 2 lakh rupees you paid for 25% stake. Early, so that means for 25% stake, the fair value is 2 lakh rupees. How much stake you had before? You had 10% stake before. For 10%, how much? If you prorate 2 lakh into 10 divided by 25, if you do, automatically you will get 80,000. That way also you can reconfirm. So the fair value of our existing investment is 80,000. And currently we are showing in our books also 80,000. But right now we are showing under FVT OCI. Is that acceptable? No, we need to cancel that. Now we'll have to show the investments using equity method. So you'll credit financial asset investment at 80,000 and debit what? Investment. Okay, it's not a financial asset now, it's an equity method. So into investment, now the investment is valued at equity method. How much value now? 2,80,000. How 280? Sir, how much did you pay for this particular 25% stake? How much did you pay? 2 lakh. We will also have to take the fair value of our existing investment. How much is fair value of existing investment? 80,000. So totally the value of investment now will be valued as equity method at 280. You will cancel FVT OCI investment at 80,000. Fine. And 2 lakh rupees you will credit bank because you got that 25% extra stake by paying 2 lakh rupees cash or check, whatever. So this is the entry you will have to pass. That's all. It's a trick. Whatever your existing investment, whatever you are showing right now, cancel that. Category shift has to happen. Okay. So going forward, you cannot value this investment at FVT OCI method. You will have to value them as per equity method. That's all. Done, people. Okay. This is one, and then there is another hidden adjustment as well. What is that? So far you have already booked a fair value gain in OCI. How much? 30,000. Sir, we know that this is a non-reclassifiable OCI, right? In equity instruments, if company has gone for irrevocable option, means this is a non-reclassifiable OCI item, right? Now, can you follow FVT OCI method? No, right? It is no more your Ind AS 109. It has gone into Ind AS 28. That means what should we do for this fair value reserve? Since that instrument is not there as per Ind AS 109, that instrument is not there. Now it is valued under equity method. So whatever fair value reserve is there, that has to be released. Where, sir, if it's a reclassifiable OCI, it will be released it into SPL. If it's non-reclassifiable OCI, then it will be released it into retained earnings. So this fair value reserve from OCI, you'll have to transfer it off to retained earnings, 30,000, 30,000. That's all you'll have to do. That's what they've done in our question also. If you just check, I'll show you the solution as well. Okay, so this is what they've done over here. So investment, journal entry and all that drama they've passed. That's it. Okay, pretty much straightforward. So why did they give net assets and all? Sir, in case of associate consolidation, goodwill, no sir, we identify. We don't account or we don't show goodwill or bargain purchase gain separately, but we identify it for disclosure purpose. So usually in majority of the problem, the net assets of the associate company on the day we got significant influence will not be available. Hence, we will not calculate goodwill. But if it is available, we need to calculate goodwill for the sake of disclosure, not for the sake of accounting. All right. So we'll have to do the goodwill calculation, which I have done it over here. How do you calculate goodwill? Same drama. How you used to calculate goodwill for subsidiary consolidation? PC, then NCI, and deduct fair value of net assets. Here, it's an associate consolidation. In associate consolidation, NCI and all will come up. No. That means straight away what take PC or cost of investment. How much? 2 lakh you paid currently and fair value of existing investment is 80,000. So total PC will become 280. Compare this with net assets. But hang on. Sir, this PC is for 100%. No. This PC is only for 35%. Correct? No. Because 10% we had before. 25% we purchased more. That means the total stake is this 2,80,000 is only for 35% stake. Now we can't compare this number with total net assets and say that balancing figure is goodwill. No. Since this number is on 35% platform, we have to take what? Our share of net assets, which is what? 35%. Do you know? Yes. On the date of significant influence, that is 1st April, the net assets. The 250 is the value of net assets on June. That is a day on which we purchased 10%. When you purchased 10%, you didn't have significant influence. So this number is not relevant for me. On the day I got significant influence, the value associate company ka net asset was 4 lakh, right? So the fair value of total assets is 4 lakh. But since it's an associate data, we will only have our share of net assets. How much is our share of net assets? 35%. Calculate that, you will get 140. right? So same 280 minus 140 you do positive number goodwill, negative number bargain purchase gain. Here it's a positive number, it is 140. Or you could say the worth of our investment is 140, we paid 280, so we paid extra. That extra only is accounted as goodwill. It's not accounted, this is the sake of disclosure. If it was a subsidiary consolidation, we will account this goodwill separately. In case of associate consolidation, we assume that this goodwill is included in the cost of the investment itself. This is only for the sake of disclosure we do it. Okay, that's the reason. If they give this data, calculate goodwill as well. Otherwise, not required. Yes, people, that's all is this about this question, right? Concept is same. We have applied this concept in subsidiary as step acquisition. Now, just that they introduced or brought in the same concept for associate consolidation. That way, this question you could say little different from the things we have worked out. So on that ground also, if you want, you can keep this question as a last day revision LDR question. Okay, people. All right. Moving on. So the next question is the highlight of the RTP, sir. This particular question you could say is the highlight of this particular RTP. Remaining everything is okay. This, yeah, it's a good question. Easy only, but a very good framing. So let's see what it is. So this is on IND AS 109 financial instruments. On 1st April 20x1, ABC issues 10-year-old bond. So they're issuing the bond. So we're not investing in bond, we're issuing bond. So it's a financial liability. Stop. We know when a company issues bonds or debentures, by default, majority of these financial liabilities will be valued under ACM method. We'll go for ACM method, right? And we know this. For ACM method, do we need fair value? No. We normally put up our ACM table and accordingly go on booking the interest charges. Yes, that's what we normally do, right? But this question is slightly different. How? Let's read the data. That way we will get to know. So it's a 10-year-old bonds or debentures we have issued at par. We have issued at face value and the face value is 15 lakh. And the coupon rate or interest rate this bond carries is 8%. Okay, which is consistent with the market rate. That means awesome. Transaction has happened at market terms. Okay, it is not off-market transaction. That means initially what's the, if transaction has happened in market terms means initially you can record the asset at the transaction price itself. But if there is any transaction cost, you need to reduce that. Right? That's what we used to say. Here, I think in this problem, there is no transaction cost. So initially, you will recognize this financial liability at 15 lakh rupees itself. Okay. All right. Then next, what's the ABC Limited uses secured overnight financing rate SOFR. SOFR. All right. As its benchmark interest rate. Earlier, this was known as LIBOR. London Interbank Offer Rate. Now, there were some difficulties in LIBOR. There was some scope of manipulation. So, LIBOR has now become SOFR. I think all this you might learn in your SFM topic. Basically, it's a benchmark rate, like an RBI rate we have, no? Like LIBOR rate, right? You can keep this as a risk-free rate, just for our understanding purpose, okay? So far as this is a benchmark rate or RBI rate or government rate, you can think like that. So, on the date of inception of the bond, on the day this bond was issued, this SOFR was, or the risk-free rate was 5%, okay? This risk-free rate was 5%. Now, sir, can we issue the bond at 5%? No. Sir, if government issues bonds, they can issue it at 5% because people have that trust in the government that government instruments are risk-free, right? So, if government wants to raise funds, they can issue the instrument at a lower rate, right? But I'm the company. Just because government is issuing their bond at 5% as a company, as a private company, okay, can I also issue on my bond, can I pay 5% interest rate? No. Obviously, there is a difference between the private limited company ka bonds and government ka bonds. Investors will not settle for 5%. They will expect more, right? Here, how much are we giving? 8%. So, risk-free rate of return is 5%. But we are giving to our bondholders 8% return because our company has some risk associated with it, right? This only we call it as a risk premium, right? In SFM, in CAPM model and all, you might have learned it in your CF Inter FM and probably in your CF Final SFM as well, right? Or AFM as now it is called, right? So basically the risk-free rate of return, RF, is 5%, okay? But we are giving how much rate? 8%. So the risk premium is 3%. We are, because ours is a private limited company and investors are taking extra risk, so we are giving an extra return of 3%. So far this is okay. All right. Now, so far as reduced, obviously, sir, this is a benchmark rate. No, this LIBOR or government rate will not be constant. Periodically, it will be reset. It will change. Now, when we issued the bond, it was 5%. Now, it has become 4.75%. Okay, sir. All right. They've given you a lot of data. I'll not go into too much of all that data. I'll tell you in simple terminology what is this question ka whole fund all about. Okay. So, first of all, if you just check over here, 1 minute. Now, I'll just tell you. show the requirement. What is the amount required to be transferred to OCI at the end of year 1 when the bond is measured at fair value? Sir, when a company issues bond, we value the investments, we value these bonds or debenture using ACM method. Correct? No, by default category, we value it at ACM method. But here they are saying the bonds are measured at a fair value. Fair value means we are going for probably FVT OCI or FVTPL, right? So why will we go for that, sir? No, we don't have FVT OCI there. For financial liability, either we have FVTPL method or ACM method. So that means indirectly we are valuing FVTPL. But they are asking how much loss or gain you will transfer to OCI. Where did this OCI come into picture at all? We never use FVT OCI method for financial liability. What came in here? There is a small concept, sir, that they have introduced over here. What is that is? Sir, there could be a small accounting mismatch. For derivatives we had it, right? So the hedged item and hedging instrument. Hedged item you might be following ACM. Hedging instrument is a derivative, we'll go for FVTPL. So there was a mismatch. Hence, if it's a cash flow hedge, so hedged item ka gain loss and hedging instrument ka gain loss, both which transferred to CFHR, cash flow hedge reserve, right? And if in case of fair value hedge also, we did the same thing. Similarly here also, if there is an accounting mismatch, so what will be the accounting mismatch? Sir, simple. Company has issued bond, right? So if company has issued a bond means probably this financial liability will be valued under ACM method. Now after issuing bond, company will use the money or company will receive the money and they will utilize this money. Suppose this money which the company raised by issuing bond, all right, the company used it for investment purpose. Company issued bond and they raised money. So they have some money now. This money, they invested. They bought some investment. All right. Now, if it is investment means either you will go for what, sir? ACM, FVT, OCI, FVTPL method, depending on what is your business model. Suppose on this investment, your business model is satisfied both by holding and selling. You don't want to hold it till maturity. You may hold it till maturity, or if you get a good price, you may sell it also. So here business model is satisfied both by holding and selling. So on this investment, you will go for which method? FVT OCI method. FVT OCI method. Now there is a mismatch. Why, sir? Sir, for debenture, you are valuing ACM method. But the money that you raised, okay, the money which you raised from using the debentures was used to purchase an investment. I mean, these two are connected. Yes, no. But this particular investment is valued at FVT OCI method. So one particular liability you're valuing under ACM method, but the money that you raised by incurring that liability, you're valuing under that investment, you're valuing under FVT OCI method, right? So ideally these are interconnected, means they should be valued under same method, right? So here there is an accounting mismatch. To avoid this, both you can go under FVTPL method. Both these instruments you can value under FVTPL method. That is what they are saying in the question, that this particular bond has got measured at fair value. The moment they say that bonds are measured at fair value, indirectly they're telling that there is an accounting mismatch here. So to avoid that, to override that, or to mitigate that, we have gone for FVTPL method. Is this okay, sir? All right, fine. So it means if you go for FVTPL method, means there will be some fair value gain loss. And that fair value gain loss, where it will go? To P&L account. Once again, I'll repeat this. Company has issued a bond. When the company has issued a bond, ideally bonds should be measured under which model? ACM method, right? So company issued bond and they have money now. This money was utilized to buy an investment. And if the business model of that investment is what is satisfied both by holding and by selling, means this investment, which is your financial asset, you will value it under FVT OCI, right? Since these two are connected, because this investment ka money came from issuing bond only. That means these two are connected. Liability you are accounting under ACM, but the asset you are accounting under FVT OCI. Since these two are connected, ideally they should be accounted using same method. Here they are not accounted under same method. So there is a mismatch. To avoid this mismatch, we'll go for which method? FVTPL method. Okay, sir. That's where that particular sentence, that the bonds were measured at fair value comes into picture. Okay, sir. All right. Sir, I have one doubt, sir. Sir, if the bond is measured at FVTPL method, means fair value gain loss will go to SPL, sir. But now they are asking how much gain loss will go to OCI. Where did OCI come into picture here? One more. What is that one more? Sir, here what they're saying is, sir, obviously now we know that we'll have to value. Both this instrument has to be valued at FVTPL now. We are sticking restricting our discussion only to the bonds, which is financial liability, right? So financial liability, to avoid accounting mismatch, we have gone for FVTPL method. If you go for FVTPL method at every reporting period, initially as well as at every reporting period, you have to value this financial liability at fair value. When you value it at fair value, you will get some fair value gain or you may get some fair value loss. So ideally that fair value gain loss, where it should go? To SPL. right? But here they have given a little more extra provision. What is that? So simple. If there is a fair value gain or loss due to market interest rate changes, if you get any fair value gain or loss due to changes in market interest rate, that you transfer it to SPL. I'll tell you what is this in this problem. It's okay. If you get any fair value, obviously if you're using FVTPL method means you will get fair value gain or loss. If that fair value gain or loss has come due to the changes in market rate of interest, you will transfer that fair value gain loss to SPL. However, if you have got any fair value gain or loss due to entities change in the credit risk, okay, if the gain or loss is due to entities conditions, all right, if the entity ka risk increased, because of that, if they've suffered any gain or loss, or if entity ka risk reduced, because of that, if you're getting any fair value gain or loss, that gain or loss should be transferred off to OCA. That is the rules recommended with respect to this. So here you will get both gain or loss. One portion of gain or loss you will have to transfer it to SPL, which is market related gain or loss. Another fair value gain or loss you will get, that is due to entities change in the credit risk. That has to be transferred off to OCA. And don't have to worry, it's a very simple question only. And if it comes, more or less same question with just a different name and different percentage may come in the examination. But overall, the concept will be similar. So once you know it, you'll not forget it and easy to score there. Okay. Now let's relate it back to this particular question. How is that? Sir, on this bond, how much interest is the company actually giving? 8%. Okay, but what is the risk-free rate of return? So far is 5%. So how much is risk premium? Because the company are issuing bond, we can't issue it at market rate, we can't issue it at government rate, we have to give extra. How much extra are we giving? 3%. Okay, people? Alright. Now this is a benchmark rate. This on the day we issued the bond, the SOFR was 5%. SOFR will keep changing, right? Now SOFR at the end of the year, end of first year, SOFR has become 4.75. 4.75. Hang on. Now the benchmark rate is 4.75%. How much is the risk premium? How much extra we gave? Now the risk-free rate of return is 4.75. Because the investors have taken a risk by investing our company, we have given how much extra? 3% extra. So 4.75 plus 3% if you do, how much is that? 7.75%. Correct, people? So 7.75%. Correct? 4.75 from 5 it has become 4.75. Is it due to entities factor? The SOFR and all is influenced by entity here. No, it's a market rate, right? So this change from 5 to 4.75 change. This is a change in the market interest rate, right? That means due to this change, if entity is getting any fair value gain loss, that will be transferred to SPL. Okay, that's the first thing we'll find out. So far, okay, but we'll go one step and then we will read the other data. Okay. So now coming back to this particular question, I've given you some basic data. So initially bonds were issued at market rate only. So the actual rate and market rate were same. So the transaction happened at market terms. Since the transaction had happened at market terms, the transaction price itself will be fair value. How much is it? 15 lakh. So initially the transaction will be recorded at fair value only. Okay. So initially financial liability will be recognized at 15 lakh of transaction price. There is no finance cost or transaction cost in this particular case. Yes. And also written the risk premium. Risk-free rate of return is 5%, but we are giving a return of 8%. So the risk premium, by investing in our company, investors are getting an extra, they are taking extra risk. So they are getting an extra return compared to the risk-free rate of which is 3%. Okay, sir. All right. Now the SOFR has become, it is not 5 anymore. It has become 4.75. So how much, because investor is taking the risk, how much extra return are we giving them? 3%. Now the risk-free rate is 4.75. We are giving them extra 3% return. Means now the rate has become 7.75. Okay, sir. So let's find out. Since it is FVTPL method, at every reporting period, we need to find fair value. Now we are at the end of first year, right? Now let's find out the fair value. How to find fair value? So there is only one basis to find fair value, which is what? Present value of future cash flows discounted at market rate, right? Present value of future cash flows are discounted at market rate. Now, what is the market rate now? Since so far there is a change, it has become how much? Don't worry about the 7.6, only concentrate on this, okay? Now the rate has become 7.75. So use 7.75% as a discount factor and find out present value of cash flows. So this is the bond issue. On bond, what and all cash flows company will incur? They have to pay interest and they have to pay principal. This bond ka term was how much? Initially when you issued, it was 10 years. Now we are doing this drama. We are finding fair value at the end of first year. So 1 year has already passed. So the remaining life is how much? 9 years. So 9 years company has to pay interest. How much interest company will pay? Interest is always calculated on the face value. So 1,50,000 was, or rather 15 lakh is a face value and actual interest rate being paid is 8%. So 15 lakh ka 8% if you do, you will get 1,20,000. That is the interest. Since interest payment will happen every year, we can use PVAF. So PVF and all, we don't have to find. The rate is how much? 7.75. At 7.75, check, they're only given. This is your 7.75. At the end of 9th year, it is 51.51 paisa. That means 0.511 rupees. All right. This is your PVIF. At 7.75%, what is PVIF for 9th year? They have given. Similarly, cumulatively for 1 to 9, they have given. This is your PVAF. At 7.75% for year 1 to year 9 put together, the PVAF is given to be 6.312. So when they give you, you don't calculate and take different decimal, take the exact decimal. So interest you have to pay every year. So this is the interest you'll have to pay every year. So multiply by PVAF given in the question 6.312. This is present value of interest. We want present value of future cash flows. Cash flows associated with the bond is interest and principal. Okay, how much is principal value? 15 lakh. Principal you will repay after at the 10th year ending, but we are in the first year ending now. So 1 year has already passed. So, okay, principal payment will only happen once. So at 7.6%, find out PVIF for 9th year. We don't have to find, they're only given. 51.1 paisa is nothing but 0.511. So 0.511 and multiply. So you will get, this is your present value of future cash flows. That is nothing but fair value. That's how we find fair value. Fair value is nothing but present value of future cash flows discounted at market rate, which we did and we got it to be how much? 15 lakh 25 or 15 lakh 23,940. This is the fair value. Okay, sir. At the end of the year. But initially, have you shown the bond at 15 lakh 23? No. Initially, we have recognized this financial liability at 15 lakh. Now its fair value has become 15 lakh 23,940. So the liability ka fair value is increased. Sir, if one liability ka value, because we are going for FVTPL method, you have to show it at fair value. So from 15 lakh, we'll have to remeasure this financial liability and bring it to 1523,940. So from 15 lakh, if you have to make it to 1523,940 means liability value is increased. So it is a fair value loss. This fair value loss is how much? 23,940. This is changed due to SOFR. Is SOFR entity specific or market specific? SOFR is a benchmark rate. It's a market specific. I mean, this is a fair value gain loss related to market. So any fair value gain or loss, if you get it due to changes in market rate, that will go where? To SPL. So this will be transferred off to SPL. Okay, sir. This is first part. Done. Okay, this is what they said. Now, I think this is okay. This is one part of the question. Now, the question doesn't end there. We still have more data. Now, they said, check, what is it? The fair value of the bond is 15,38,110. This value is consistent with an interest rate of 7.6%. So now the rate is not 7.75. So far we found out the rate at what, sir? 7.75. Now they are saying the value is consistent. They have given the fair value of the bond as 15,38,110 with which is consistent with the interest rate of 7.6%. So actually it is not 7.75. It has become 7.6. So if it had become 7.75 means that we could say it is changes due to market return, right? It is changes due to market return. But is it 7.75? No, it has become 7.6. From 7.75, if it has become 7.6 means this movement from 7.75 to 7.6, this is not due to market influence. This is due to entities influence. Maybe credit risk of the company has reduced. That's the reason instead of paying 7.75, investors are ready to settle for 7.6. If a company is safe means we will accept lower rate. If company is risky means investors will expect higher return. So instead of 7.75, investors are ready to settle for 7.6 means they are ready to settle for a little lower rate because what? Entity ka risk probably has reduced or whatever reason this is, right? So this is an entity specific. So now due to entity specific, if there is any fair value gain or loss, that you will transfer it off to OCI account. Okay, that's what we'll have to calculate over here. That's all. Okay, people. Then they've given you these things. The remaining cash for value of the bond is 1,20,000 per year, which we know already interest, 15 lakh at the end of 9th year principal. Using that, they've used 7.6% as a rate and they've already calculated the fair value to be 1538. That's what, we don't have to do that. They've already given. That means what, sir? Right now we are valuing the bond at 1523,940. Can we take it at 1523? No. Here, not only market interest rate has changed, but also some entity ka risk profile also has changed. That means another fair value gain or loss is there. Till now we valued the instrument at 1523. Okay, but at 7.6%, which is the actual rate, what is the fair value? We don't have to compute. We already computed at 7.75. At 7.6, they only given. The fair value at 7.6 given in the question is 1538. That means what? Again from 1523, we have to bring the value of that financial liability to 1538. From 1523, we need to make it to 1538. That means we need to increase liability. Increase in liability means obviously it's a fair value loss. So means from here to here, what is the difference? If these two are difference, if you find, that is 14,170. That is due to changes in entity ka credit risk or entity specific factor risk. This particular fair value gain loss, you'll have to book it in OCI account. Okay, non-reclassifiable OCI item. The instrument is there, this will be there in OCI. This is what they asked you in the question. How much will you transfer to OCI? Which is 14,170. That's all. Okay, easy question, good concept. That's all. Okay, let's quickly summarize this question once. What is it? So ideally, bond should be measured at ACM. But to avoid accounting mismatch, okay, we are following FVTPL method. So if you're following FVTPL method means initially as well as at every reporting period, you have to value the instrument at fair value. And you will get some fair value gain loss. Ideally, that fair value gain loss should go where? SPL account. But here there is an extra concept. What is that? So first check what if that fair value gain or loss is due to changes in market interest rate. If you are getting any fair value gain or loss due to market interest rate, then that fair value gain loss you will transfer it to SPL. However, if you are getting any fair value gain or loss due to entity specific factor, then that fair value gain loss you will have to transfer it to OCI. Okay. Now coming back to the question, initially benchmark rate was 5. We were giving interest to the bondholders at the rate of 8. So we were giving 3% extra return because obviously we are not a risk-free entity. Only government, RBI and all are risk-free instruments. Private limited company ka bonds and all will not be considered as a risk-free. That's the reason we are giving 3% extra return to our investors. This was initially. Okay. Now this is a benchmark rate. When we issued it, this benchmark rate was 5%, but at the end of the year, it has become 4.75. All right. So 4.75 is a risk-free rate of return, but to our investors, we gave how much extra return? 3%. That means the rate should have been how much? 7.75. Okay. So market SOFR rate change. SOFR is a market rate change. So due to this market change rate, the rate now has become 7.75. Okay. So now we have to use this as a rate and find out the fair value. We are at the end of the year. So every reporting period by bond has to be measured at fair value. How do you get fair value? Present value of future cash flows discounted at market rate. What is the market rate? 7.75. So find out the present value of future cash flows using 7.75. You got it to be how much? You got it to be 15,23,940. Initially, till now you are showing the bond at 15 lakh. Now from 15 lakh you have to bring it to 15,23,940. So you have to increase the value of liability due to market change risk. This is due to SOFR change. SOFR is a market specific. So this, if you are increasing a liability, means it's a loss. This loss you will transfer it to SPL. That is one part. Only that change? No. Actually now they are saying the rate is not 7.75, it has become 7.6. From 7.75, it has become 7.6, means this change is not market specific, this is entity specific. So again at 7.76, 7.6%, you need to find fair value. How? Same. Present value of future cash flows discounted at 7.6. That exercise we don't have to do. They've already done that for us. They're using 7.6% as a discount factor. They only calculated the fair value to be 1538. Okay. At 7.6%, the fair value is 1538. But now before this, we were showing financial liability only at 1523. From 1523, again you have to make it to 1538. Liability value, again you have to increase by how much? 14,170. This is due to entity specific. So this is the liability, if you are increasing, means it's a fair value loss. This is an entity credit risk change. So this particular loss, you'll transfer it off to OCI account. And after this transaction, the financial liability revised balance will become 1538,110. That's all. But they did not ask that. They asked how much to OCI. 14,170 will go off to OCI. That's what they've done in the solution also. If you want, you can just confirm. Here, the final answer. So liability, you will show the liability at 1538,110 finally, and this 14,170 will go off to OCI. Simple 2-3 calculations. If you do it, done. Looks fancy first time when you do it, but after that, pretty much straightforward. Okay, easily you will get it. Okay, all right. So just pay attention to this particular one question because yeah, it's a new question, new framing. We didn't have this at all. Okay, so this is done. So 12th is done. Next is what, sir? 13th, 14th, these are all repetitive question we are not doing. 13th, 14th, 15th, all are there in our class note itself, repetitive. 16 is also repetitive. 17th question, same, ditto, cut, copy, paste is there. Okay, I think this one, 16th one, we have a similar question. Okay, the value is changed, that's all. Okay, the name and value they've changed, but we have some same, just the name and little different value that you can manage. 17th is also same. 18th one, yeah, 18th also according to me, same only. We have done a couple of cash flow questions, but okay, maybe in the interest of time, we will quickly review this particular question. Question number 18. The opening, one second. The opening balance sheet at 1st April 2006 of an Indian company which accounts for transaction in INR consists of 1 lakh rupees cash and share capital 1 lakh. So yeah, we just started a company maybe with a share capital of 1 lakh, hence capital and cash balance both are 1 lakh on that particular date. The company borrows a long-term loan on 30th September. 6 months later, company has borrowed a loan. But we have done this transaction not in our functional currency INR. We have done it in foreign currency called US dollars. How much loan have you borrowed? 2,200. When you took the borrowing rate was 87. We know this. IND AS 21 says that initially all the transaction, doesn't matter whether it is a monetary item or a non-monetary item, everything will be recorded using transaction date ka spot rate. So you will convert this using 87 rupees. So the journal entry will be bank account debit to foreign currency loan or financial liability. 2,200 you will convert it at 87. So 2,200 into 87 will give you, this is the value of the loan initially by converting using TDSR, transaction date ka spot rate. Okay. Then IND AS 21 says that at the end of the year on the reporting date, if any monetary item has any balance, monetary item means those components whose value is fixed. So if you take a loan of $2,200, you have to repay how much? If you take a principal of $2,200, you have to repay a principal of 2,200 only. So the value is fixed, right? So I'm not talking about interest. I'm talking about the principal. Principal portion only is what you show as a loan in your balance sheet, right? So since the principal portion is fixed, loan taken, loan given, debtors, creditor, bill receivable, bills payable, cash in hand, cash at bank, all these are examples of monetary item. And IND AS 21 says that if monetary item has any balance, that balance should be shown in your balance sheet, or monetary item should be shown in your balance sheet on the reporting date using closing rate. You have to reconvert using closing rate and show it. Okay. Now, there were no other transaction during the year. At the end of the year, that is 31st March, again 6 months later, the rate has become 85. From 87, it has become 85. I think here you will get an exchange gain. So how, sir? Sir, initially, obviously, sir, if you have taken a loan, means you have to repay the loan, right? To repay the loan, you have to repay the loan in dollars. To repay dollars, first you need to purchase dollars. No? So when you took the loan, you thought that you can purchase $1. You can purchase $1 by giving away a Gandhi note of 87 rupees. By giving away 87 rupees Gandhi note, you can purchase $1. But at the end of the year, I'm smiling. Why? So I can purchase $1 just by giving 85. I can purchase $1 just by giving 85. So I'm giving how much rupees lesser? I can buy $1 by giving 2 rupees less. So it's a gain for me. So on $1, the gain is 2 rupees. But have we done the transaction for $1? No, $2,200. How much is the exchange gain? $2,200 into 2 if you do, the exchange gain is 4,400. Since there is an exchange gain, right, you'll have to reduce the liability, right? Because we'll not pay this much amount now, right? Okay. So what is the entry for this? So financial liability loan account debit to SPL account 4,400. Yes, this is the entry will pass. Just 1 second now. Some system went off. I think, yeah, we're still there. Yeah, cool. Great. I think we are there. We're back. Okay, so we booked an exchange gain. So the entry for the exchange gain is financial liability loan account debit to, it's a monetary item exchange gain which will be transferred off to SPL 4,400. Yes, people. This is the entry we have passed. Now, what is the requirement of the question? Sir, they've given you some data. Using this, you need to prepare cash flow statement. There is no other transaction. You just started the business with 1 lakh rupees cash and you took a loan. Other than this, there is no other transaction. So we'll have to do this. So they've given balance sheet. Retained earnings. Retained earnings is nothing but SPL. SPL, after doing all the adjustment, whatever SPL ka balance remain, that only we call it as retained earnings. So how much is retained earnings? 4,400. What is that 4,400? That 4,400 rupees is the exchange gain. Okay. So that's what we have done. So the balance, obviously, since they've given profit ka balance, we have to do under indirect method, because under direct method, we want to know cash flow from debtors, creditors and all directly. All that information is not given. Since they've given profit information, from profit, we'll try to get operating cash flow. Hence, it is indirect method. We are using indirect method here because to use direct method, we don't have information. So under indirect method, we start with profit. How much is the profit? 4,400. Okay, sir. But this 4,400 rupees is what? This 4,400 is due to exchange gain. So did you really get this gain? Did you really get this gain? No, this is a bookish gain. This is a gain due to forex fluctuation. Did we really get this gain in our bank account? No. So hence what, sir? This is it's like a depreciation. Depreciation is a non-cash expense we used to add back. This is not an expense, this is a gain, but it is a non-cash in nature. We have not realized this. So can we show this? No. So reduce this unrealized forex gain, 4,400. Okay. That means what, sir? Any other transaction is there? No other transaction is there. That means the net cash flow from operating activity is 0. Then net cash flow from investing activity is also zero. No information. That's all. They've not given any of this. If you just check, yes, it is just WhatsApp. On the asset side, we have cash. On the liability side, we have share capital, retained earnings, and loan. We don't have any other assets. So investing activity ka cash flow is zero. What about financing activity? Sir, loan taken is what activity? Financing activity. So initially when you took a loan, how much money came into your bank account in Indian rupees? 191,400. So 191,400 is the money received from loan taken, which is a financing activity. It's an inflow, so you will show it as a positive number. This is only transaction because they know where they talked about interest paid and blah blah. So we can't calculate. They have not given any information. So from financing activity, while net cash flow from financing activity is 191,400. So from operating cash flow 0, net investing cash flow is 0, net cash flow from financing activity is 191,400. So adding all the three activities, the net increase or decrease in cash equivalent is 191,400. Okay, people. To this, we need to add opening cash balance and compulsorily get the closing cash balance. We started the business with what value? Initially, we started a business with 1 lakh cash. So opening cash and cash equivalent is 1 lakh. So closing cash and cash equivalent will be 291,400. That's all it is. Fine, people. That's what they asked. In fact, in our question, we had done one more extra step. We had done reconciliation also, right? That also we had told, but here they have not asked the reconciliation. Because cash and cash equivalent is shown in your balance sheet using closing rate, right? So we'll have to measure that. But anyway, that was slightly a different question. When you have money in your foreign bank account, what to do? Here, that is not the case. It's a normal loan. So that's the reason probably reconciliation is not required. That's all is this particular cash flow statement question. Okay, very, very straightforward question. Nothing much. That's all. Over, literally. Okay, so this is also done. Yeah, same. Not much different. So if you want, you can quickly review this particular question as well. Question 19 is a IND AS 24 ka related party disclosure wala question. So let's see what we can learn from this question. Mr. Y's father ka father owns 100% shares in A Limited. Alright. Sir, is father a close family member? Yes. Father, mother, siblings, your spouse, children, domestic partner, all these are close family members for IND AS 24 purpose. So whether Y owns shares in A Limited or Y ka father owns shares in A Limited, doesn't matter. Anyway, Y's father and Y are close family members. It will be considered as one and the same. Yes. And Mr. Y and Mrs. Y own 100% shares in B Limited. So the husband and wife put together, okay, they own 100% shares in B. Alright. So that's okay. These are again close family members. So who owns it doesn't matter. Both put together is owning 100%. Fine, whatever percentage among them is irrelevant. Now Miss Z, who is Mrs. Y ka sister, okay, now they have stretched our Vamsha Vriksha. Okay, Mrs. Y has a sister called Miss Z. She is providing some bookkeeping, accounting services from time to time to B Limited. Okay, however, Miss Z is not an employee of B Limited. She's just a consultant giving some service. That's okay. You don't have to be. For you to be a related party, you don't have to be an employee. As long as you are a related party and if any transaction has happened, you need to give a disclosure. Whether you are employee or not an employee is irrelevant. That is one. A Limited. And giving bookkeeping service is not a KMP, sir. Like KMP is the person in charge of planning, directing, controlling the activities, relevant activities of an enterprise. So if you're giving accounting service and all, then Miss Z over here, she's giving some accounting service to B Limited. No, so Miss Z is not a KMP. Accountant is not a KMP. All right. That is one. All right. However, this is done. A Limited has increased its loan of 1.5 lakh rupees to B Limited for 2 lakh. So A has given already some loan of 1.5 lakh earlier. Now that loan from 1.5 lakh, they've increased it to 2 lakh. So additional loan of 50,000 is probably given in the current year. This is what they've done. So they've given a lot of crazy data, right? This person, that person, and all. So first thing in related party transaction is to put up that chart. Right? How is the relationship or who is happening? So what they told, Mrs. or Mr. Y's father owns 100% in Y Limited. So Y ka father owns 100% in A Limited. This is a chart they are representing. Okay. Then there is Mr. Y and Mrs. Y. They own 100% in B Limited. Okay. Fair enough. Then what? Now Mrs. Y has a sister called Miss Z. Now Mrs. Y has a sister called Miss Z. Okay, she is giving some accounting service or bookkeeping service to B Limited. This is what is happening. Okay. Now, first, let's identify who is a related party. So, first of all these are close family members. Yes or no? All these are close family members. That means what? Sir? It's a father. Mr. Y's father and Mr. Y, they are related party. And we know this. We use our simple arrow approach. If one of the downward arrow is control or joint control, means other downward arrow should be control, joint control, significant influence, or KMP, doesn't matter. These two will become related party. So Y owns 100% in A. Y also, Y's father owns 100% in A, and Y and husband and wife put together own 100% in B. So are these two related parties? Very much yes. Both the side we have a control. So they become related party. I'm using the arrow approach. Yes, that is one. And anyway, Mr. Y's father and Mr. Y, they're all close family members. They automatically, it doesn't matter. It's as good as saying Mr. Y only owns the shares in both the companies for our understanding purpose. So are these two related party? Yes. Are these two related party? Yeah, control is their related party. Are these two related party? Yes, they're related party. Sir, if Mrs. Y and B Limited are related party, means if Miss Y and B Limited are related party, means only Mrs. Y and B will be related party, or even close family member also. Mrs. Y ka close family member and that company also will become related party. Yes, no people, not only that person, if a person is a related party to a company, means that person ka close family member and that company also will become a related party. That's the definition which we had told. Yes. So here in this case, since Mrs. Y and B Limited are a related party, the close family member of Mrs. Y, which is sister, and B Limited, they'll also become what, sir? These two also will become a related party. That means it looks like everyone is related to each other. Yes. Now what are they asking in the question? State whether Y's ka father and Y's ka sister are related party for B Limited. So for B Limited, they are asking, is this father O and this sister O, are they related to B Limited? Obviously, they are related to B Limited. Yes. Answer is yes, they are related to each other. That is one. They are also asking, is B Limited required to disclose dealing with the sister of Mrs. Y in financial statement? Now, the sister is giving some bookkeeping service to B Limited. No? So obviously, so they might be charging some money. So there is a transaction, related part. Are they first of all related party? Yes. Mrs. Y ka sister, that is Mrs. Z and B Limited, they are a related party. Is there any transaction happening between these two? Yes. So should that be disclosed? Yes, it should be disclosed. So the answer to this question is yes, they should be disclosed. Fine. Alright, that is one. Next requirement is, what disclosure should be made in the financial statements of A Limited and B Limited in respect of loan given by A to B? So first of all, is A and B a related party? Yes. One of the downward arrow is control, other side is also control. So are these two related party? Yes. Is there any related party transaction happening between to them? Yes. A has given a loan. A in fact had given a loan to B, probably previously only how much? 1.5 lakh. In the current year, from 1.5 lakh, they have made the loan to 2 lakh rupees. So extra loan of 50,000 is given by A to B in the current year. So are they related party? Yes. Is there any related party transaction happening? Yes. Should that be disclosed? Yes. They're asking, what is that disclosure you will give? You will simply give the name of the related party, nature of relationship, nature of transaction, amount outstanding, etc., etc. So that particular data here, loan transaction has happened. No, so you will call out like that. We have given an additional loan of 50,000 in the current year. And at the end of the reporting period, the loan outstanding balance is 2 lakh, whatever, how much ever balance they are showing. That depends on loan given as an ACM method, no financial asset. So you have to show that loan ka outstanding balance. Assuming it is 2 lakh, you'll write like that. So that disclosure requirements has to be given over there. A simple question, that's all. But a good construction, that's all. Okay, fine. That is with respect to the 19th question, right? Okay, now the last question on IND AS 102, share-based payment. A good question in my view. Again, this one also I'll keep it as an LDR question. LDR is in last day revision question. Good framing. We'll see. On 1st April 20x1, an entity enters into a share-based payment arrangement with its employees. Great. The terms of the award are as follows. Employees are required to work for the entity for 5 years. So these shares do not vest immediately. The shares will be given only if the employee works for 5 years. I mean that 5 years is your vesting period. Okay. After which they'll receive a cash payment equal to the value of entity share. We know this, no sir. A share-based payment plan of 3 types. Equity settled plan, cash settled plan, equity settled plan with cash alternative. Either equity shares can be given. If directly equity shares are given, means we call it as equity settled plan. If cash is given to employees but based on the share price, we call it as cash settled plan. Or third one is equity settled plan with cash alternative. Employee can choose whether the shares or cash. Employee has a choice to select it, or for that matter, company also may have a choice. That we call it as equity settled plan with cash alternative. Yes, but here it looks like we are giving cash. So far reading the first pointer, it looks like it is a cash settled plan so far, right? So let's read the second point. If the entity achieves a successful IPO, if they go for the listing during the 5-year period, then employees will receive free shares rather than cash. So by chance, within this 5 years ka duration, if company goes for IPO, if company ka shares gets listed, then instead of cash, they will automatically get cash. No choice, compulsory. Rather than cash, the employees will straight away get shares. So employees might receive free shares at the end of IPO or cash settlement, but not both. Okay. So employee does not have choice here. Normally, on first time when you read this question, it may look like this is an equity settled plan with cash alternative. No, this is not equity settled plan with cash alternative. Because if it is equity settled plan with cash alternative, we have steps. No, we will record SBPR, share based payment reserve also, share based payment liability also. How to do it also? In fact, we know this, right? On the grant day, we find out what is the fair value for equity settled plan, what is the fair value for a cash settled plan. The difference between those two we recorded as SBPR, and that is recognized over vesting period. That is accounting we do for equity settled plan with cash alternative. Sir, to apply equity settled plan with cash alternative, you should have a choice. Here there is a choice. No, it is no choice matter, right? If IPO happens, means compulsory shares. If IPO does not happen, means compulsorily cash. So there is no choice with the entity or for that matter company over here. Yes. So that means you can't do this wala accounting. That is not this question. Okay. That's the reason this question is different. So that means how to do the accounting, I'll tell you. Alright. No employees are expected to leave the entity over the next 5 years. So none of them are expected to leave. Great. That means 100% of the options probably will get vested over here. At the date of the award, that is what you came up with this award on 1st April 20x1, that only we call it as GD, as in grant date. Okay. On the date of the award, that is a grant date, and till the end of 2nd year, from the day you came out with this plan till 2nd year, it was not probable that successful IPO would occur before 5 years. For the first 2 years, company was of the opinion that, or company ka estimates and company ka thought process was, IPO will not happen. It is not probable that successful IPO will occur. So that means if IPO occurs only, we will give shares. As if IPO occurs, company will give shares. Compulsorily, we will give shares. Company is feeling what? Till 2nd year, company thought that IPO will not happen. That means till 2nd year, company will have to account this as what plan? If IPO will not happen, means company will give cash. So till 2nd year, you'll have to account this as a cash settled plan. I hope this is clear. Yes. Okay. Now what happened? Check. At the end of 3rd year, now comes the 3rd year, Shani wala Rahu Ketu Vastu year. In 3rd year, a successful IPO became probable. In the 3rd year, it became evidence. Maybe we got a sufficient enough proof to prove that IPO will happen. IPO will happen, and management expects that IPO will happen in 4th year only, not 5th year. Okay. So now, if IPO happens in 4th year, means should employees serve for 5 years? No. Service period of 5 years is required for getting cash. If employee wants to get cash, means they have to serve for 5 years. If IPO happens, means will company give cash? No, automatically shares will be given, right? So whenever IPO happens, company will give the shares. If IPO happens in 4th year, means then we will automatically give shares in 4th year. Okay, keep that in mind. So in the 3rd year, it became apparent that company will go for IPO by the end of 4th year. Okay, that is one there thing. At the end of 4th year, successful IPO actually happened, and the employee received free shares. Great. So the vesting happened only in the 4th year only. The fair value of equity settled award alternative 1000 is on the grant date. We know, no, sir. For equity settled plan, we'll have to use grant date ka fair value. For cash settled plan, in case of cash settled plan, company has an obligation to pay cash. Whenever there is an obligation, at every reporting period, we have to measure our obligation. So if it is cash settled plan, we'll take the fair value of the option at the end of each year. But if it is equity settled plan, for equity, there is no remeasurement concept. So for equity, we only take the grant date ka fair value. On the grant date, the fair value of one option is given to be 1000 that they've given. Okay, keep that in mind. So here, I think so far when we read the question, I think we got to know. What is it? For first 2 years, the thought process was this is an cash settled plan because IPO was not probable. But after 2nd year, that is in the 3rd year, it became apparent that the company will go for IPO. That means 3rd and 4th year, you'll have to account this as equity settled plan. Why only 4th year? Because actually IPO happened only in the 4th year. Though initially they mentioned the period as 5 years, actual IPO has happened in 4th year. The shares will be given. Actually, shares will be given to the employees by the end of 4th year. Okay, this one. That means we'll have to change our accounting. For the first 2 years, you'll have to account it as a cash settled plan. And then you'll have to change your accounting from cash settled plan. You'll have to change your accounting to equity settled plan. That's what you'll have to do over here. Okay, this is one. That way, this question is good. Easy only, but good. Okay. All right. Ignoring the what is that? The fair value of cash settled alternative is what they have given. For cash settled plan, we need fair value at the end of each year. That's what they've given. 1, 2, 3, 4. They've given. Why only 4? Because anyway, we gave shares only. No, that's the reason they've only given the fair value for 4 years. You need to pass. How should we do the accounting? Okay, very straightforward questions. And now if you get it, means as long as you have got it, calculation is pretty straightforward. For first 2 years, you'll have to account this as a cash settled plan and do your normal accounting. For third and fourth year, you'll have to do it as equity settled plan. So before we do the accounting, normally we put up a working note. What is that? Employee benefit expense. This is the format we have used for all our question. So I brought in the same thing. First, number of options expected to vest. Here they told in the question that all the employees are expected to stay. So the number of options expected to vest, have taken it as 100%. They have not given any other data. How many options actually and all we have given, they have not told. Hence, I'll not be able to compute that. So I've just taken it as 100%. Next, fair value of the option. Now stop. For first 2 years, for here this is important. For first 2 years, it is what plan? IPO was not probable. So for the first 2 years, you'll have to account this as a cash settled plan. For cash settled plan, we need grant date ka fair value or at the end of every year ka fair value. End of every year ka. So first year ka fair value was how much, sir? Fair value of the option for first year and second year is 50 and 500 respectively, which I have copied. 1 minute. Here 50 and 500. Got it? Okay. Now first let's do 1 year ka calculation. Vesting period. Sir, when it was when will you give cash? You will give cash to the employees only if they serve for how many years? Only if they serve for 5 years. So if you are settling by cash, means they have to work for 5 years. In the first year, the thought process was that only. That company will not go for IPO and the company will settle this plan by giving cash. For company to give cash, the employee has to work for 5 years. So the vesting period is 5 years. So do the calculation. What is that? Total expense to be recognized, right? So the loss on one option is 50. All right. So we know this, the loss as per IND AS 102, the loss will be booked over the vesting period. So this loss, they have not given number of options. So we have to ignore that, right? So 50 is the loss. If you want, you can write 100% also here or ignore that. That's fine. All right. So 50 is the loss that you'll have to book over the vesting period. How much is the vesting period? 5 years. So first year, how much you will book? 10. We are in the first year. So expense recognized previously is 0. So in the current year, you have to book an expense of 10. This is a cash settle plan ka expense. Keep that in mind. So what is the journal entry for cash settle expense? Employee benefit expense account debit to share based payment liability. So first year you have to book the expense like this. Employee benefit expense to share based payment liability 10. This employee benefit expense will be transferred off to SPL account. That's what we have done here. Okay, I mean, yeah, they have not done the transfer entry, but that's okay. This will go off to SPL. Correct? Now same calculation for second year. Second year also, what is the thought process? Company still feels, for first 2 years, company feels IPO will not happen. I mean, for second year also, thought process is, it is a cash settle plan. How many options are expected to vest? They said all the employees will stay. So 100%. By the end of second year, now the fair value has become 500. The loss on one option is 500. And you have to book it over vesting period. Vesting period is how many years? 5 years. We are in the second year. So means 2/5 of the total expense you have to recognize. Yes. So 500 is a total expense. You have to book it over 5 years. So since we are in the second year, so totally 2 years ka put together, you should have recognized that expense. Hence 2/5. So totally by the end of second year, you should have recognized how much? 200. But we are in the second year. Have you already recognized some expense in the previous year? Yeah. First year, you already booked how much? 10. Total expense till the end of second year is 200. In that 200, 10 is already recognized. So how much is the expense for the current year? 190. So you have to book the expense for 190 in the second year. Entry is employee benefit expenditure to SBPL 190. Okay, sir. This is for second year. Now, third year onwards, what happened? From third year onwards, company felt that now IPO has become probable. That means it will not be. We will not be settling it in cash. We will be settling it in equity shares. That means it will become equity settle plan. But hang on. Till now, we have booked share-based payment liability. And we know if it is a cash settle plan, we book share-based payment liability. If it is equity settle plan, we book a reserve, SBPR, share-based payment reserve, right? So till now we have booked a liability called SBPL. Is that liability required anymore? Are we going to settle this in cash? No. Hence what to do? From SBPL, whatever balance is there, you have to transfer it to SBPR. That you have to do. So in the next year, because the things changed in the third year, no? Right? So in the third year, in ending, whatever SBPL balance you have, how much balance we have in SBPL? We can check our working also. Where is that working? Total balance in SBPL is how much? First year you passed an entry for 10, second year for 190. So the total balance is 200. So 200 from SBPL, you have to transfer it to SBPR. So liability has credit balance. To cancel, we will debit it. So SBPL to SBPR, 200, 200. This is what you have to do. This is the extra fitting. That's all. Calculation ditto. Yeah, okay, people. This is one. Then third year ka equity settled plan ka accounting you do. For equity settled plan, you know the accounting. No? What is that? Number of options expected to vest still 100%. Fair value. So for equity settled plan, do we take each year ka fair value? No. For equity settled plan, we always take the grant date ka fair value, because for equity there is no remeasurement concept. Now go back to the question. On the grant date, what is the fair value they told? On the grant date, the fair value is 1000. So take this particular number. Just one second. 1000 rupees is a fair value. For next 2 years, we'll take the grant date ka fair value and do the accounting. Now vesting period, don't take it as 5 years. Company feels IPO will happen by 4 years, right? By 4th year, IPO will happen. So that means the total vesting period will become 4 and 4 over here. And now do the simple calculation. So 1000 is a loss for one option. You'll have to book it over 4 years. We are in the 3rd year. Hence 3/4 of that expenditure you should have recognized, which is how much? 750. So totally you should have booked an expense of 750. But till now you have recognized how much? 200. Right? Because first year you booked an expense of 10, second year 190. So total 200 is already recognized. By the end of 3rd year, totally you should have recognized 750. In that 200 is already booked, means expense for the 3rd year is 550. So you have to book this as an expense for 3rd year. But mind you, this is equity settled plan ka expense. So the entry will be employee benefit expense account debit to share based payment reserve. How much? 550. So that's what they've done here. Employee, this for 3rd year. Okay. Employee benefit expense to SBPR 550. Okay, G. Now 4th year. Number of option expected to vest 100%. For equity settled plan, we take grant date ka fair value, which is 1000. Vesting period, they told in the question that IPO will happen, and it did happen in 4th year only. So total vesting period 4 years. So what is the total loss? The loss on one option is 1000, correct? They've not given number of options, so you can take total loss itself as 1000. So we are in 4th year. So that means entire 1000 should have been recognized by the end of 4th year. By the end of 4th year, totally you should have recognized 1000. But so far, how much have you recognized? Till 3rd year, you have already recognized 750. Totally you should have recognized 1000. Till now, we have booked 750. So additional expense you need to book for 4th year is 250. It's an equity settled plan expense. So entry will be employee benefit expense account debit to SBPR 250, 250. And 4th year, what happened? Actually, shares were issued. Alright, till the time you issue the shares, you will park the amount in SBPR, share-based payment reserve. Once the actual shares are issued, when the employee buys the shares or the shares are issued at free of cost or whatever. So when the shares are issued from SBPR, you will transfer it to equity share capital, right? So then when the shares actually got issued, SBPR account debit 1000 to equity share capital. Why 1000? Because totally you booked an expense of 1000. So total balance in SBPR, if you check, it will be 1000. You can calculate that through your journal entry also, right? So total balance in SBPR is 1000. So entry is SBPR account debit to equity share capital 1000. Okay, fine. If the shares are issued at premium, then you will transfer that premium element to securities premium. Data not given. So SPF securities premium is taken as 0 and entire amount is transferred to equity share capital. That's all is this question all. Okay. So yes, so accounting is easy, but you have to identify that for the first 2 years, it was a cash settled plan. Then it has become an equity settled plan. That if you are able to identify, and then normal accounting you know of. Okay, that is the highlight of this particular question. Okay, so yeah, 2-3 questions overall has been newly framed, pretty good. Other than that, pretty much straightforward RTPs. All right. So thank you for your time and patience. All the best. Bye bye.